So I want to welcome everyone to the Next Gen Mentoring Forum. The Next Gen Mentoring Forum series is designed to build the financial planning with the purpose of inspiring critical thought and discussion. In today's session, Dr. Chien takes a hard look at actual retirement statistics from multiple government surveys to answer those questions and calculate the effects of specific strategies on retirement sustainability. My name is Josiah Gonzalez. I am the Graduate Program Specialist in the School of Management. I am your host today. I'm a proud CLU alum from the MPPA program. Dr. Jali Chien is an assistant professor and director of the financial planning program at California Lutheran University. She maintains an active financial planning practice specialized in succession program management at the Value Growth Institute. She's authored 3 books. Most recent peer-reviewed research books is by Palgrave Macmillan, Springer Nature, titled Enhancing Retirement Success Rates in the United States, Leveraging Reverse Mortgages, Delaying Social Security, and Exploring Continuous Work. Next Gen Mentoring Forum is sponsored by California Lutheran University School of Management Financial Planning Program. We offer MBA in financial planning that helps financial advisors pursue a leadership position or grow their financial planning practice by deploying advanced financial planning, effective client communication, counseling, streamlined practice management, as well as leverage financial tech. Thank you, Dr. Chien. We're so glad to have you for the Next Gen Mentoring Forum.
Oh, yes, I'm here. I'm just waiting for your cue. All right, are we ready to go?
Yes, we're all set.
Okay, thank you. Welcome, everyone, and Happy New Year. I know that it's a little late for most of you, but still in a Chinese celebration of the New Year. So Happy New Year and happy golden red year of the Chinese New Year. Anytime when I talk to somebody regarding about retirement, this is kind of a picture that I always receive. Someone or a couple that are extremely happy they finally made it to the retirement stage. And they're traveling around the world and they're very happy in their relationship. They enjoy the family gatherings and they're traveling around the world and especially traveling to places that has nobody in there. So they are actually have the entire place to themselves. And this is typical type of retirement image that I typically see from people who are describing to me as a client or advisors who is helping me understand their practice. Before I get started, I wanted to help everyone participate in today's session. And so on my screen, I have a URL link. If you could participate, that will be great. And Josiah is going to put that into the chat box. You can go ahead and click on that to get ready for my next questions coming up. So I will have 3 questions today for you to participate in. So get ready for that. So I'm going to give you a moment to make sure you have that copy somewhere or click into a different website, and then we'll come back to it in just a little bit. So for those of you who are joining a little bit late, this is the URL I'm going to be asking you to keep during the session. All right, so regarding about retirement, that wonderful image of the retirement, and as a matter of fact, my husband oftentimes tells me that picture as well, so it's not very far off from I typically hear. Another thing about the retirement is that retirement, generally speaking, break it into 2 parts. One is what we call the accumulation stage. The other one is called the decumulation stage. Okay, I'm going to try to mute everyone so can reduce the sorry, I also muted myself. All right. So in the retirement, usually not only that we as a person like to have that beautiful image of the retirement, the planners or financial practitioners you're working with also have that assumption in the background when they actually do their calculation. Obviously, our job is to make sure that we address all sorts of different risks. So let's go through in a scenario here. for the most part, when I present this particular information, people sometimes tells me that they started working when they are about age 20, roughly. Some of you probably work earlier than that. And during your work year, you have a fantastic career path. Nothing ever happened to you. There's no unemployment interruptions. Family is great. You get along with your family and your children doesn't bug you. And you continue to save, very disciplinedly saving that along the line until you get to a point of here that you decided that I have enough saved and I want to retire. And so at this age, depending upon what you do, most of the executives will tell me that that's 50 for them. Most of other people will tell me that, well, that's 60 for them. So depending upon where you are, everyone has a different definition. If I were to ask someone in my undergraduate course, they will tell me 30, of course. And so, yes, you can see that depending upon what you say, and I'm going to use 60 for the time being of the calculation, that we know that I have to work about 40 years continuously saving until that point of retirement, and then I can go wild. I can start spending, assuming that I'm going to go spending disciplinedly during the retirement. And I'm going to assume that at some point, either 90, 95, or 110, whichever that age group is, let's assume 90 for the time being, that I am just going to die right here. And I still have about $1 left in my account. And we call that a successful retirement. The key here is as long as you have $1 left in your account and you die there, and you will have a successful retirement. Now, obviously, this is not a very realistic picture, is it? Because oftentimes we will hear people getting laid off here, or there's some sort of family situation they have to go support. They have to spend money here. Or most likely down to this close to this age here, you are going to support someone who is in your family going through college. And sometimes the person will get some health problem during this stage, during this golden years, if you will. There's going to be some sort of health problem here. And while you are enjoying the world of traveling, you might spend too much here. Before you know it, you spend too much, or your family member needs your support here, such as paying for a wedding or other things. And ultimately, something that all of us are fearful, including our clients are, we are going to outlive our assets. And so this is a picture that oftentimes that it may look so perfect until we factor into all these various problems. So when I also looked at clients coming through the door that asking that whether or not they could retire, the very first questions I often ask them is, so what will you do? Because it's not about just going to retirement. There's something that you want to do during retirement, whether or not it's travel or golf every day, which I have seen clients do. At the end of the day, they will all come back and tell me that they don't feel like their life is fulfilled during retirement. So what you do is going to dictate quite a bit about what is your spending pattern looks like in retirement. So make sure you, before you go to that planning stage, ask yourself, what will you do actually in retirement? The other things that in the financial planning or financial advisors services industries that there's one key issue that we oftentimes do face, and that is that we often talk to clients about various different type of assets. Specifically, the assets that we look for are down here, this block. This is the block that we often look for. How much do you have in your brokerage account? How much do you have in your retirement account? How much cash value insurance that do you have in place? How much of is in your annuities? And then they do various different kind of simulation to figure it out that do you have enough to support your retirement. That's not a bad thing. Unfortunately, we have to look at the entire picture and something called the retirement balance sheet. On the left-hand side is your assets. On the right-hand side is your liabilities. On the asset side, we typically have what we call the human capital. Human capital including two things. Either you continue to work or even work part-time, right? So some people feel like they don't need to make money, but it would be nice if they continue to make some income. If they do, they are stretching their assets. The other thing is social capital. Social capital includes the Social Security, includes your Medicare, includes pension. If you're lucky enough to have pension, congratulations. Most of us don't have that. Or family and community. Those are your social capital. And then there are two other assets that oftentimes don't necessarily get to talk about. And one is your real estate, direct real estate investment, which possibly is your rental property. And the other one is your direct investment of your business holding. All of these are your assets. In reality, clients use all of these during their retirement, not just this portion of the portfolio of financial assets. And so oftentimes you do need to help clients to look beyond the financial portfolio of assets. All of these assets has to be matched to the right-hand side of the liabilities. That includes your standard of living. This is your fixed expenses, something that you need to live, and that's your needs. Then you have your discretionary income. This is discretionary expenses, that includes your travel, your lifestyle, any kind of improvement, home improvement, or some sort of improvement that you need to do in your life. Then you have your contingency. This is the part that financial industry, financial planning, financial services industry do very good job of. They're trying to protect you from any kind of risks that potentially will damage your assets. So contingencies such as your long-term cares, healthcare, and other type of spending. And last but not least is your legacy goal. Many of us have the luxury and pleasure to work with many clients that do have a lot of assets that can consider the legacy goals. Remember, all of these are competing objectives. And so depending upon where you are in your situation, all of that needs to be taken into consideration. So most likely, typically, when you are visiting a financial planning practice or financial advisor's firm, we all get into the habit of running a simulation based on this particular formula. For those of you who know what I'm talking about here, I'm just going to go through briefly what they look like. There is some sort of problem with this formula. The formula is fine, but there are so many different assumptions. And assumptions here is, first off, I don't know when I'm going to die. I know I will die, but I don't know when, right? And oftentimes, many advisors will simply say, well, I think you're very healthy. You're going to die at 95. Great. Someone thinks that I'm going to die at 95, but what if I live? Here is the problem, guys. Most of us don't die. That's the problem. We will die at some point, but we just don't die quickly enough. And that's why we're worried about the assets is not going to last us enough. The other thing is that we don't know what the market return is going to be. This is the market return. And oftentimes, depending upon when you retire, there's a terminology called the sequence of the return. Depending upon when you retire, that sequence of a return, if you retire in a bad timing, that's not very good. You won't have much to stretch it out. And the other things that we oftentimes worry about is the inflation. So the inflation here has various different types. Living expenses has inflation, medical expenses has inflation, or any other type of expenses that you have in mind has a different type of inflation that all needs to be looked at. And most importantly, we actually don't know how much that we are going to be spending. Ideally, we like to spend at a fixed dollar amount, but that's just not going to be realistic. So 2 years ago, I decided to take on a journey to figure it out. So how realistically from a US retiree population, their success looks like in retirement. So I went to the Census Department and I asked the Census Department to provide me with a set of data. And these are the data the Census Department collect every 10 years. So the data that I collected from was 2012. That includes all sorts of different households in the US that is 62 and older, is already collecting Social Security. And so I define them as retirees. And they are either couple or single by living together as a couple or as a single, no one else living with them. So that's the census data, has household information. Then I go to Morningstar to take all the market returns starting from 1926 all the way to 2018 to make a rolling return rather than an average return. So that means that I can simulate the data based on all sorts of different type of returns in the market. Then I went to Social Security Administration. I asked them, so how do you determine when the Social Security recipients will die? The Social Security Administration has a table called Life Table. And this table, as a matter of fact, Social Security actually calculate each one of our life till 119. Whether or not you like it, that's how they calculate it. They're betting that all of us will die before that. But they just still have to calculate people who doesn't die until 119 or even later. They have to have the money ready for them. So I use that to simulate the survivalship of the household to see what is the probability for them to survive to 119. Then I went to the Statistic Bureau and asked them to show me what is the retirees' average expense of every single state. And every single state is not one expense. It breaks it into 5 different age groups, from 62 to 65, 65 to 70, 70 to 75, 75 to 80, and 80 and above. 5 different age groups. All 5 different age groups has a different retirement expenses associated with it. Therefore, we can't just use a flat amount to simulate your client's situation. So there's 5 age group with the different expenses associated with it. Then what I do is I put them through a simulation to see what's the success looks like in the entire US. That will give me the base model, what I call the base model. From there, and I started to put in 3 different types of retirement strategy, and that's very, very common being used today if you work with a financial advisor or if you work with your clients. So the first one is that someone would delay Social Security until their full retirement age or age 70. That's the first strategy oftentimes you hear people talk about. The second strategy is you continue to work. Okay? And the way that I simulate that is, what if you work 1 year, 3 years, or 5 years? And last but not least, I simulate what if we consider home equity as a strategy to see how successful that will look like. So besides the base, I've simulated the 3 different types of strategies to look at how successful the retiree population is in the US. But that doesn't necessarily answer much of the questions if I just look at the success, because success has a different definition. And my definition here is, as long as you have a penny left when you die, you are successful. So what I did is that instead of setting the success rate at 100%, I actually set it at 90%. 90% success rate, and then I calculate whether or not you are able to spend above that state average expenses for that particular state. And then I calculate what's the population looks like in every single one of the states. So the idea behind here is I used the real household assets that's been collected from the census data, run through how Social Security is managing our mortality rate, and run through how the expenses looks like on the national basis on every single state to see how successful are we as a nation. All right, so here's what we have. You should have the URL already in the chat box. Go ahead and click on that. What I'd like you to do is to answer the questions. So what do you think is the weighted average success rate in the US retirees for the couples and for the singles. So if you have the URL, click on the URL and answer the questions, please. What do you think? This is looking at the success rate of the US retirees. Ooh, we have a equal of the amount in here. Very interesting. So a third of us here thinks that couples has about 55% success rate, single has about 63, and then or couple has 65 or 43, or couple has 80 and 70. For those of you choosing C, you have a very, very confidence level for the US retirees. So correct answer is actually this one here. Oh, somebody's changing the answer on the fly. Yeah, so it's roughly about 65.9% of the population in the US retirees will make it. And then about 43% of the single will make it. But remember, the success rate isn't something that I'm looking for. So I'm going to flip the picture a little bit to see from a population perspective, what's the population looks like when I set the success rate at 90%. So this is a key point when you are doing planning for your clients, or if you're working with the financial planning professionals, you need to define what success rate is. Whether or not you define it as 100%, in my case, I set it at 90%, which is already very high. But if you set it at 70% or 60%, that will vary depending upon the actual outcome. So watch out for the success rate that you set when you do the planning. Here's what I have in, let me clear the screen here. Here's what I found from a base population perspective. There's always a myth that you need to have at least $1 million to retire. And as a matter of fact, that's actually hold true. If you look on the chart, this is the base model. This means that no strategy hasn't been applied yet. People who have over $1 million net worth, over $1 million net worth, and if you look at this right-hand side is the singles, left-hand side is the couples, they are both group has above 80% of the populations actually do well. What I mean by doing well means that they can spend on average above the average for that particular state retiree expenses. And you might be asking, well, most of your clients have more than $1 million. That's true, but you have to keep in mind, in the US, there's only 13 million millionaires, which means that for retirees, that number goes down drastically. Therefore, I only show you a chart that shows up to that particular bracket. So that means that higher net worth still drives higher success, that allowing your clients or allowing you to spend above average of that particular state. So let's take a look at the next one. And I'm going to ask you to start taking notes, especially I'm going to show you only 6 different states. And if you want to have more state information, those information will come later on in the program. But if you could, jot down some of these numbers as I move along, and we're going to do a comparison later on. So let's take a look at California as an example. California only have about half of the married couple, or about a third of the singles that will be able to spend above average of that state retiree expenses in able to meet that 90% success rate. And if I look at Texas, very popular retiree states, all the states that I'm showing you are very popular retiree states. Texas has only about 61% in couples, and single has about 40%. Let's take a look at Pennsylvania, also very popular. Pennsylvania doesn't have income tax on the Social Security. But Pennsylvania has about 52% in couples and 41% in single. Florida, one of the very popular retiree states, Florida couple is 63% and single is 44%. New York, 56% for couples, 44% for singles. And Arizona, you can see a big difference here. Arizona jumped up quite a bit. The couple has 86%, single has 62%, and Oregon 77% for couple and single 41%. the concept behind here, a lot of people, when they saw this chart, they would tell me, well, I get it. You want me to stay and married. No, that's not what I meant. Because one of us, if you are married, one of you will die. So you really need to think about how to protect the surviving spouse, because chances are your surviving spouse are not able to make it to the end. And so when you look at the information like this, it's great that you're looking at it from a couple's perspective, but keep in mind, one of us will die first. And so we need to plan for that last to die, making sure that they have enough to get through their last day of life. Okay, so I hope that you have an opportunity to jot down some of these numbers. And because of the time concern, I'm only going to show you the strategy on the HACM, which is reverse mortgage. What will the reverse mortgage use? Will that actually enhance the retiree's success during the retirement? So go ahead and put in your answer. Is it no, reverse mortgage is a scam? Maybe, it depends. Or yes, for those qualified. So what do you think? Watching what the actual numbers coming back. As a matter of fact, the reason I put mortgage is a scam is because a lot of the clients, when I mention that to them, they actually tell me, no, that's a scam. So if you are working with clients and if you hear that from a client, that is the perception that they're looking at, and you need to watch out for that. All right, so the correct answer here is actually if those who qualify for HACM. We won't have a lot of time to talk about the actual qualification for. I'm going to briefly talk about it. So HACM has to be, the youngest of the couple has to be 62 years old, and most of your mortgage has already been paid off, not a very large outstanding balance. If you do have a balance, you do have to have a cash to pay them off, and you have to attend the federally appointed counselors to make sure that you understand the terms of that reverse mortgage. And you don't have to pay back, but if you do not use all of them, everything else will go to your heir. So this is kind of a brief description for that. So yes, so if I looked at the HACM strategy only, and so I'm going to turn to you to look at, okay, so we apply the HACM strategies into the overall population. What do you think the improvement is? So go ahead and check in your improvement rate. Is it only on a national basis, 5% of the couple improved, 10% of the single, or is it 12% of the couples and 18% of the single, or 21% versus 28% singles? What do you think? One of the interesting things that in my research is actually, besides looking at how much improvement that we get out of using reverse mortgage, I also show every single state average net worth, every single state percentage of the household actually qualify for HACM. And so in this case, on the national basis, it is only about 5% or so for couple and 10% for single. But depending upon the state, so in a moment when I show you the chart, you will actually see which state actually has the most improvement in there. So thank you very much for participating in that. So I'm gonna go through it quickly so you can actually see them. So California actually, for the couple, improves about 10% or so. And so does a single. Texas also improved, not as much as California, but still improved. Pennsylvania jumped up, but not as much as California. Florida actually jumped up as well. And New York significantly increased. So keep in mind, if you live in the area, if your clients live in the area that have a high real estate value, that's not a bad idea to consider. But keep in mind, reverse mortgage does have a cap. So you do need to watch out for the cap. It's not like you own a $3 million, you can take $3 million. No, the cap is roughly about close to about $800,000 or so. Arizona, it's close to almost 90% of the population will make it if they use a reverse mortgage. And Oregon has close to about 80% for couple and half of the single. So HACM actually does work depending upon where you live, depending upon real estate value, and depending upon your situation. It's not being highly recommended from many of the financial planning professional, primarily because, number one, there's a misconception. As I mentioned earlier, clients believe it's a scam. Number two, advisor actually also don't know enough about reverse mortgage to make proper recommendation. And so there are two misconceptions coming in to really not helping clients think through the bigger picture. Now, by just recommending reverse mortgage or any strategies that I've talked about previously, you also need to look at, so what works in what demographics? So for example, for HACM, if I just compare the improvement portion of it, you can see based on net worth, single versus couple, you can see single typically do better compared to couple, right? And if you notice that the net worth between $250,000 to $500,000 is probably the most effective group of demographics that you can ask your clients to consider that. People who tend to have over $1 million may or may not be that much of an improvement when you're using the HACM strategy. So when you wanted to recommend this to the clients, you also need to look at, is that particular state has the most improvement or not, and whether or not your clients within a certain type of demographics that makes sense. The other way to look at this, since we looked at the couple and the single, we also looked at what if a certain age group actually do better compared to the other. So you could probably see the older group here actually do far better compared to the younger one. This only concerned about if you actually take the withdrawal on a regular basis. However, if you were to use the HACM line of credit, then the younger will be a better place to be. So really, each one of the strategy before you actually recommend to your clients, you need to understand how the best way to recommend that to your clients so they can take advantage of strategy like this. Overall, from the study, that it is very obvious that oftentimes we are helping clients to diversify within that financial portfolio assets, which is your retirement account, your savings, and all that. But the key here is to diversify of all sorts of assets, including working longer, such as human capital, including home equities, including your social capital, such as delaying Social Security, as well as having a direct ownership of real estate or direct ownership of a business. The other thing is that you do want to keep in mind when you are planning, you need to plan for the last to die, not for the both together. Because that last person to die, as you can see earlier slide, when it turned to a single stage, that's the most vulnerable stage where that particular person will not survive. And other thing is that there are simple things that we all can do is to control the spending. We still have control over that. You can downsize, you can relocate, you can cohabitate. In the research, I actually show various different charts for showing particular states, and that will help you kind of analyze and help your clients go through which particular state is the best fit if downsizing or relocation is one of those strategies to consider. And the other things that I also found is that not one single strategy can take care of everything. You need to help your clients to combine multiple strategies to actually make it work. Last but not least, please be nice to your family. I already told my daughter many, many years, I'm coming to live with her. If all fails, I am living with you. So be nice to your kids, be nice to your friends. You just never know if something were to happen, they are still your lifeline at the end. So be nice to them. So with that, I know that you may have questions, and if you do, you can actually put that in the chat box, or you can, and I'll try to get to the questions in a little bit. The link on the page shows you the URL that you can actually get more information about the book. So I do have questions in the chat box. Josiah, would you mind to copy paste that URL into the chat box? Okay, thank you. So Lynn has a questions regarding about, is it lower for couple versus single because they lose Social Security when one dies? No. The way the simulation works is that as all of us know that when you are a married couple, when one of you die, the other one actually gets to receive a higher Social Security if two of you, one of you is receiving higher amount, then you get to receive the higher amount. So it's not because of Social Security. The reason the single has a much lower compared to couple is because when you are two together, you tend to spend a lot. When you're down to single, we oftentimes assume the single person is going to spend half. That's not the case. Oftentimes, the spending keeps up. Remember the census, statistics that I took from the Bureau of Statistics. It shows couple and singles, so that expenses really not necessarily is 50%. And sometimes they're very, very close to the couple spending. So oftentimes that's a flaw when we are planning for the clients, and we're assuming too optimistic, if you will, on the spending side. And the other reason why the single are much lower is because majority of the single are widow. And we are not planning for one last person surviving, and that's probably one of the biggest issue that we do run into when you're planning for the client. All right, with that, I don't have any additional questions, but if you do have questions, you can always reach me in the email, and I'm going to turn the floor back to Josiah.
Thank you, Dr. Chien. We're so glad to have you for the Next Gen Mentoring Forum. It's a very informative session. Thank you to all our participants, and thank California Lutheran University School of Management Financial Planning Program for sponsoring today's Next Gen Mentoring Forum. California Lutheran University School of Management offers MBAs in financial planning, helps financial advisors pursue a leadership position or grow their financial planning practice by deploying advanced financial planning, effective client communications and counseling, streamline practice management, as well as leverage financial tech. Please sign up for our info session for more information. Our next Next Gen Mentoring session is on Thursday, February 13th, 2020 at 1 p.m. Pacific Standard Time. Please join Dr. Jen to interview Dr. Daralee Barbara about women in financial services. Thank you all, and see you at the Next Gen Mentoring Forum.